Welcome to all. Today, as a part of the course on insolvency and bankruptcy law in India, today we are going to discuss various committee reports on the insolvency. So, in the previous class, we have discussed about overview of SICA, that is Sikh Industrial Company Special Provisions Act 1985, then establishment of board BIFR, then we have discussed about constitution of appellate authority, then problems with the SICA. So in the previous class we have discussed the overview of SICA. So today we are going to start the concept of various committees related to insolvency law in India. So as a part of that, today we are going to start with the committee of Tiwari Committee Report 1981. Let us discuss the background and context of Tiwari Committee. So during 1970s and 1980s, okay, India witnessed a rise in industrial sickness. Okay, so we have adopted the industrial policies, various industrial policies were adopted and industries were encouraged. But the fact is that because of so many reasons, in 1970s and 1980s, okay, so industrial sickness was there. We have witnessed the industrial sickness. Okay, particularly in case of large and medium sized companies, okay, so which were operating in the core sectors and they were all becoming the sick industries. Okay, so that is one of the basic problem that we are facing in 1970s and 1980s. Okay, so what is the impact of this sickness? So the impact of this sickness is lockup of large investment. And please remember, first we have concentrated, okay, after our independence we have concentrated on the large scale industries. Okay, so government started investing in large scale industries and all these industries were established by 1960s and by 1960s only they have established 1960s 1970s. So because of the management issues and other things, by 90s, by 70s, 1970s and 1980s, okay, so majority of these industries became sick. I cannot say all the industries, but there are problems are there. Okay, so lockup of large investments. So we have made large investment in these industries, and now that is locked up. Okay, and wastage of natural resources, national resources. Okay, so all the factors of production, that is land, okay, capital, everything is wasted, and loss of employment. Then stress financial institutions due to raising of NPS, even because of this sickness in the industries, it also caused NPS, non-performing assets, in the balance sheet of banking institutions also. Okay, so which adversely impacted the banking institutions also. Then the existing legal framework, if you observe, that is, I'm talking about 1980s. Okay, so at that point of time, the existing legal framework was only in Companies Act 1956. Okay, so at that point of time, we don't have much provisions, okay, which are exclusively dealing with restructuring or revival of such companies. Okay, so now under the Companies Act 2013, we are having provisions relating to arrangements, okay, whereby you can go for any kind of arrangements. But we don't have such provisions for the restructuring and revival of such companies during that period. This was a problem at that point of time. So in this background, okay, so they were having this committee. Okay, so to address these problems, the government of India, they have constituted a committee called as Tiwari Committee under the R.G. Tiwari, Secretary of the Department of Heavy Industries. So under the chairmanship of R.G. Tiwari, this committee was formed. Now what is the mandate of this committee? The mandate of this committee is to examine the causes of industrial sickness, okay, and they are expected to recommend preventive, corrective and curative measures. So how can you prevent? That means before an industry is becoming sick, how can you prevent? How can you correct? That means already done, okay, so already sickness is there. So how can you correct? How can you cure? Okay, so the loss is there, how can you cure? Okay, so they are supposed to recommend preventive, corrective and curative measures. Okay, then suggest institutional framework for revival or closure of sick industrial companies. So government gave the mandate that you have to give the suggestions for institutional framework and develop mechanism for coordination between banks, financial institutions and the government. Okay, so because at that point of time banking institutions are regulated by RBI, and there is no comprehensive mechanism where, because central government or the government, they were concentrating on industrialization and banks were working separately. Okay, so that's why there is no coordination between the banks and other financial institutions. Okay, so NBFCs and other financial institutions and the government. There was no coordination. Okay, so that's why we should have a mechanism to have the coordination between these banks, financial institutions, and the government. Okay, so this is the basic object of this committee. Now they have recommend they based on the mandate given by the government, they gave the recommendations. Now let us discuss various recommendations of the committee. Subsequently, how these recommendations were incorporated in the legislation or policy framework, and what are all the changes that happened or that took place based on these recommendations. Okay, now let us look at the recommendations. Okay, so they have defined and they have given the definition for an identification of sickness. Okay, so they suggested objective financial criteria for identifying the sickness. So this committee suggested that we need to have an objective criteria. So that means maybe based on the erosion of net worth, or if any company is getting continuously losses. Okay, or if any defaults are there continuously to the financial institutions. Okay, so these are a few examples. Okay, so one company is unable to make the payment to the financial institutions, that is they borrowed the money but they were unable to pay non-performing assets. Okay, so your net worth is eroded over a period of time, or continuously you are getting the losses. Okay, so in these cases a particular company can be considered to be sick company. Okay, so they try to define what is the meaning of sick company. Okay, then they recommended a watch list system for early detection of potential sickness. Okay, so it's better, instead of reacting after the sickness, if you can react in advance, if you can prevent the sickness. Okay, which will help the economy as a whole. Why? Because if any company went, or if any industry becomes sick, then lot of employment and other things, economic activities will be stalled. So that's why it's better if we can detect the potential sickness in advance, then it helps us in reducing the sickness and it helps us in protecting the economy as a whole. Okay, so that's why this committee recommended a watch list system for early detection of potential sickness. Okay, then creation of quasi judicial body. So this committee recommended for creation of quasi judicial body. Okay, so like which is centralized, which is independent, and which is exclusively dealing with sick companies. Okay, so the body would assess viability and recommend either rehabilitation or winding up. Okay, so whenever there is a possibility, the body, that is quasi judicial body, should concentrate on rehabilitation of the industry. Okay, so in case if the rehabilitation failed, then in such cases you can go for winding up of the company or winding up of the entity. Okay, so that is the recommendation given by the committee. Okay, then based on these recommendations, okay, so they have created, central government has created BIFR, Board for Industrial and Financial Reconstruction. Okay, then AAIFRS. Okay, so IFR, Appellate Authority for Industrial and Financial Reconstruction, AAIFR. Okay, so as we have discussed, okay, so there is a centralized authority must be there, and there should be appellate authority must be there. Okay, so if you are not satisfied with the BAFR, then there should be mechanism. Okay, so that's why based on the recommendations given by this committee, now we are having this. Okay, now they recommended for time-bound rehabilitation framework. Okay, so suggested strict timelines for preparing and implementation of revival schemes. But whether it happened really or not, we will discuss this later. Okay, so but this committee recommended that, okay, whenever if you are going for rehabilitation of any sick industry, this should happen within the time framework. Okay, then emphasize that delays defeats the purpose of revival as the financial and operational conditions worsen over the time. So this committee also warned the government that if there is a delay is there, okay, so if there is a delay is there, then automatically the assets value will reduce in any company. Okay, so that's why The basic purpose of these legislations is to arrive, or I can say maximization of the assets, early detection of the sickness, then ensure that subsequently when rehabilitation process implemented, you are going to realize the assets. Okay, even in case of winding up also, you are going to realize assets quickly so that the loss can be minimized. But if there is a delay is there, then automatically it is going to impact the entire process. Okay, so that's why this committee strongly recommended that there should not be any delay. Okay, then they insisted on the financial and institutional coordination. Okay, so recommended coordination actions among banks and financial institutions, central and state governments, then industry regulators, okay, and proposed debt restructuring, interest concessions, and capital infusion for viable units. So this committee also recommended, okay, so this committee recommended that there should be coordination, as already we have discussed in the mandates. Okay, one of the mandate given by the central government to the committee is that, okay, so can we have any coordination among the institutions? So this committee recommended the coordination among the banks and financial institutions, central and state government, because central government is framing some policies, state government is framing some policies, there should be, okay, some uniformity among the central government and state government, and industry regulators will be there. So these people should coordinate with each other. Okay, and they also propose, suppose if any industry is viable, now it is running into the losses, but if you can provide a debt restructuring, or if you can provide some additional capital, then in such cases, or if you can give some flexibility in repayment of the debts, in such cases you can revive the company. Okay, so in case of viable units, okay, this committee also recommended that there should be debt restructuring mechanism or else interest concession, so you are reducing the interest, even that is also possible. Then exit strategy for non-viable, suppose after rehabilitation, after considering the company, if the BAFR is of the opinion that, okay, it is not viable to revive the company, then in such cases there should be exit strategy. Okay, so if the revival is not possible, speedy liquidation was advised to prevent the wastage of resources. Okay, so instead of wasting the resources, if you can quickly dispose of the assets, okay, and if you can liquidate the company quickly, then in such cases you are going to save the resources. Okay, then emphasize on released locked assets for re-employment in productive sector. So once if you can recover the assets, that is capital, then the same capital can be reinvested somewhere else. Okay, then prevention of sickness, call for better corporate governance, early warning system, and management accountability. So corporate governance norms were introduced, I cannot say introduced, okay, so they were modified, and early warning systems must also be there in a company, and suggested regulated monitoring of the financial health of industries. Okay, then what happened based on these recommendations? Okay, so these are all the various recommendations given by the committee. Okay, then do we have any impact, or whether these recommendations had any impact? Yes. Okay, so first impact is that they have enacted, central government has enacted SICA, Sikh Industrial Companies Act, okay, 1985. Then based on the Tiwari committee, okay, Sikh Industrial Companies Special Provisions Act was enacted, and they have established BAFR. So as already I told you, committee gave the recommendations to establish quasi-judicial body. Okay, there is nothing but BAFR. Okay, then they have also established AAIFR. Okay, served as an appellate body. Then what are the powers of BAFR under SICA? Under SICA, BAFR is going to determine the sickness of the company and appoint the operating agencies to prepare the revival plan. Okay, so is there any possibility of revival? Then they are expected to prepare the revival plan, then sanction, modify, or reject the rehabilitation plan. So these are all the powers of BAFR under SICA. So even in the previous classes also, so we have discussed about the powers of BAFR under SICA. That is session number 6. Then recommend winding up of the unviable companies. So after the process is completed, if the BAFR is of the opinion that the revival of the company is practically impossible, then in such cases they can recommend the winding up of unviable companies. Okay, so what is the criticism? So though the committee recommended that we need to have speedy disposal of the cases, but practically speaking, even BAFR also was following the basic code procedures only. Okay, procedural aspect. So the case is dragged for 5 years actually. Okay, few years. Okay, where with no effective resolution. So they were unable to come to the resolution, and few years. Okay, so sometimes 5 to 6 years, 10 years, the cases used to run. Okay, so there is a problem with the BAFR. Okay, then companies use BAFR process to avoid the creditor action and delay enforcement. So even the corporate debtor, that is the board of directors or companies also, even they started using this BAFR as a mode where they can circumvent or bypass the provisions of other legislations. Okay. Then lack of credit control. So this system was debtor friendly. Okay, so with limited say for the banks and financial institutions, so they don't have any control over the corporate debtor. Okay, then poor coordination, financial institution, though the committee recommended that there should be coordination between financial institution, government departments, but the fact is that there is no coordination among the departments. Okay, financial institution, government departments, and BFR often lack synergy in implementation of revival plans. Okay, so they don't implement the proper plannings. Okay, then abuse of process. So many promoters use BFR to avoid the liquidation while continuing to erode the values. So these are all the various criticism. Okay, so against the SICA Act. Okay, now let us conclude. Okay, how the Tiwari committee report is important to the Indian economy. Okay, so the Tiwari committee report of 1981 was a milestone in Indian corporate rescue framework. So while its implementation through SICA and BFR may not be successful, okay, so it's not successful, but fact is that, okay, the idea of early detection, institutional investor intervention, and revival versus liquidation. Okay, so these are all became foundations for insolvency law. Okay, so in the subsequent lessons, we are going to discuss about IBC, Insolvency Bankruptcy Code. Okay, so where this concept of revival of the company, that is they have used the word CRP process. Okay, so the concept of revival of the company in case of a failure, let us go for liquidation. So all this basic ideology is developed. Okay, so based on the Tiwari committee report. Now let us look at the other committee. Okay, today we'll discuss another committee report also. Narasimham committee report 1991-1998. Okay, so please remember, when you are talking about the Narasimham committee report 1991, even you have to consider the economic scenarios or economic position of the economy as a whole. Okay, so you have to understand. Okay, so India was in the middle of the severe balance of payment crisis. So at that point of time, when you observe the balance of payment is, it's a very problematic scenario that we had. Okay, so the balance of payment crisis and the on the verge of economic collapse. Okay, that is where actually we came up with the LPG policy, liberalization, privatization, globalization, where the entire economy, the structure of the economy has been shifted. Okay, so the government initiated economic liberalization and financial sector reforms were deemed critical. So the Committee on Financial System, chaired by M. Narasimhan, was constituted in the year of 1991 in the month of August. Okay, so Narasimhan Committee was constituted. Okay, so Narasimhan Committee, please remember, it is not totally for the purpose of insolvency law. Okay, so it is generally. Then, what is the basic objective of this committee? So, strengthening the banking system in a liberalized economy. So, now 1991, they decided to go for liberalization policy. Okay, so in the liberalization policy or in the liberalized economy, you are expected to have a strong banking system. So, that is the basic objective of this committee. Okay, then improve the efficiency and profitability of financial institution. How to improve the efficiency and profitability? You have to identify. Reduce the role of director credits, then address the growing concern about bad loans and insolvency in the banking system. Okay, so bad loans are increasing and also insolvency is also increasing. So you have to address the these concerns. Now let us look at the recommendations made by this committee. So reduction of statutory preemptions. So SLR, CRR. Okay, so SLR, statutory liquid ratio. Okay, so CRR, cash reserve ratios were absorbing a large share of banks fund because you are expected to maintain the SLR and CRR funds. So the money is blocked already. So that's why they thought of reducing the statutory preemptions. Okay, then suggested reducing SLR from 38.5% to 25% and CRR in a phased manner, because your CRR is directly going to impact the credit availability. Okay, so you have to reduce the CRR, so then the availability of the credit with the banking institution tends to increase. Okay, then free up resources for productive lending. These are all the various recommendations. Okay, then recognition and classification of NPAs. So introduce the concept of non-performing assets for the first time. Previously there was no concept of NPA previously. Then recommended classification of advances into standard, substandard, doubtful, and loss assets. So these assets with the banking institution, okay, whenever you are doing the auditing, the assets of the banking institutions must be categorized into this: standard, substandard, doubtful, and loss assets. So according to the standard, according to the classification, you are going to take the action accordingly. Okay. Then propose provisioning norms for NPS to ensure transparency and prudential management. Then capital adequacy norms, suggested capital adequacy ratio CAR for 8% in line with Basel 1 norms. Then stressed on capital infusion for public sector banks by the government. So they insisted that government has to invest more on the public banks, public sector banks. Okay, then autonomy of public sector banks, recommended reducing government interference in daily operations. So this committee recommended that previously in banking operations, government used to interfere. Okay, because they were having nominee directors. Okay, so they used to interfere. But this committee recommended that government should not interfere. It's a business activity. Let it happen like that. Okay, so recommended reducing the government interference in daily operations and proposed setting up of Banking Bureau, Board of Bureau, BBB, Bank Board Bureau for appointments and governance. Then suggested listing of banks and stock exchanges for market discipline. So even they suggested that these banks should go for listing also. So that is how we are having so many companies, banking institution. Nowadays they are listed. Okay. Then directed credit and priority sector lending. So recommended gradual phasing out of priority sector lending. So previously they used to lend to only priority sector only. So you have to phase out. Then propose limit it to 10% of total credit, focusing on truly need. So instead of going for priority sector, so previously when the government decides so and so is priority sector, whether the project is viable or not, banks used to give the loans. So instead of that, limit 10% of total credit. Generally, remaining 90% you are expected to concentrate on the need actually. Okay, wherever there is a need is there, so you have to give the loan. So then you can grow as a banking institution. Okay. Then they suggested certain recommendations for strengthening the financial institutions also, like encourage professional governance in development financial institution. Then promoted competition among the financial institution to improve service delivery. So these are all the various recommendations made by the committee. Now, what happened? Okay, so whether the committee recommendations had any impact on the policy framework? Yes. Okay, so NPA concept was institutionalized. RBI notified that, subsequently NPA concept. Then gradual reduction of SLR and CRR, even that also happened, so that the credit availability in the market is also increased. Okay, then basis for enacting prudential banking regulations by RBI. So these recommendations acted as a basis for RBI also to frame the regulations accordingly. Then led to restructuring and recapitalization of banks in the late 90s. Then influenced the creation of Debt Recovery Tribunal (DRT) system under the RDD-BFI Act 1993. Okay, so these are all the various recommendations and the implementation of the Narasimham Committee Report 1. Then in the year of 1998, again central government they formed another committee with the same person as the chairman, Narasimhan Committee Report 2. Okay, so that's why it is called as Narasimhan Committee Report. Okay, so what are the existing problems at that point of time? Okay, so high levels of NPS. Okay, though we have liberalized economy, but still we are having high level of NPS. Okay, and poor recovery of loans. The recovery of the loans was very worst actually. It is very bad. Okay, so weak legal system for debt enforcement because they don't have proper system to enforce the debt. They used to approach the civil courts only. Then inadequate capital and inefficient banking structure. Then in December 1999, so this is the background actually. Okay, though 1991 we are having Narasimhan Committee report, then subsequently we made the changes, but by 1998 still the problem is continuing. Okay, so that's why second committee under the chairmanship of M. Narasimham was set up to examine the progress and recommend further reforms. Okay, now let us look at the recommendations. What are the recommendations? Legal and institutional reforms. Emphasize credit empowerment and fast recovery mechanism. Recommended creation of asset reconstruction companies, ARC system. So there is a new concept at that point of time. ARC system was introduced. Then strong push for legislation enabling banks to enforce security without court intervention. That is how SARFAESI Act came into picture. Okay, so that is the basis for SARFAESI Act. Then strengthening the DRT system also, the debt recovery tribunal system. Suggested reforms in DRT functioning to make them more efficient. They suggested some constructive recommendations. Okay, so those recommendations were implemented. Then emphasized technology adoption. So the technology was growing at that time only. Okay, so they encourage the technology and they emphasize that technology adoption must be there and improve staffing and time bound disposal of the cases. Okay, so these are all the various recommendations given by the committee. Okay, then apart from this, they have given the recommendations relating to bank capital and Basel norms also. So advocated raising of CER to 9%, okay, and to later 10% over a period of time. Then recommended risk weightage asset management. Then called for coverage, provision coverage ratio and tighter asset classification. So these are all the various recommendations given in this committee. Then propose a three-tier banking structure whereby large international banks will be there at the at one level. Then national banks with wide presence will be there. Then regional banks for local presence. Okay, so large international banks, national banks, and regional bank. So this is what supported. Okay, then they recommended voluntary merger of strong banks to create globally competitive. Okay, so if banks want, because previously we used to have so many banks, so if they want to compete with each other, they should be strong. So that's why they recommended voluntary mergers among the banks so that they can globally compete with other players. Okay, so these are all the recommendations. Then governance in banks, they advocated appointment of independent director. So they have introduced the concept of governance system in the banks also. Okay, then they recommended. Then called removal of dual control by RBI and finance ministry. So previously finance ministry, RBI both used to manage. Now they said only RBI. Okay, then asset management companies, AMCs. So asset reconstruction companies and asset management companies. Okay, so they propose AMC to take over the NPS. So NPS were in the hands of banking institution. Now this committee recommended that banking institution should concentrate only on their business. The NPS must be transferred to asset management companies, AMCs. Okay, then encourage public-private partnership in bad asset resolution. Okay, so these are all the various recommendations given by this committee. Now let us look at the impact of 1998 report. So it led to SARFAESI Act 2002. That is a major, I can say, benefit of this committee. Then strengthen the DRT system through amendments to RDDB BFI Act. It helped in conceptualizing the ARCs like ARCIL. Okay, at that time only we were having ARCIL company also. These are all the various, I can say, changes that took place because based on the recommendations. Okay, push for recapitalization, consolidation of banks in a later years. So these are all the various things. Okay, now let us conclude these two reports. Okay, so revolutionized India's financial sector, and they were instrumental in laying down the foundation for SARFAESI Act and DRTs, ARCs. Subsequently, these helped in the IBC in the next years, coming years. Okay, so let us recap what we have discussed today. Today we started the concept of various committees relating to insolvency. As a part of various committees, in today's lesson we have discussed Tiwari committee report. So in the Tiwari committee report provided for background, while discussing the Tiwari committee report, we have discussed the background in which the Tiwari committee came into picture, and the context of committee and mandate of the committee, then key recommendations given by the Tiwari committee. Then subsequently we started with the concept of Narasimham committee report. So Narasimham committee report, we are having two parts: Narasimham committee report 1 1991 and report 2 1998. Okay, then we have discussed about the objectives of this committee, then recommendations given by this committee, then impact of these committees, how it impacted the legal framework in India. Okay, so this is what we have discussed today, and tomorrow we are going to discuss other committee recommendations and other committees relating to insolvency law in India. Thank you.